Welcome back to the Brent Bruce Daily. Today is Monday, the 27th of February. It is now 3:07 p.m. Central Time, and we're going to take a look and see where we are at right now. Just a little bit of a heads up. We are doing better today. Mortgage-backed security market is improving after we know a couple of tough weeks. We're going to talk about the calendar that we have coming in the month of March and all the excitement that we're going to be facing. Really looking for that turnaround after what has been a very difficult February. But we're also going to take a look at a report here from Diana Olick when it comes to the basic housing market. So we get this report from her. She's usually pretty negative on housing, kind of the shock jock of CNBC when it comes to the housing market reports. So it says here a rush of homes go under contract in January, but it is unlikely to last. I think that is actually a very good analysis. That's a good expectation for her because she's reporting for the month of January and she's comparing January to December. Well, of course, we had a better number in January because interest rates did what? They went down. At one point, not too long ago, you remember I was talking about 5.875% with no points on the Brent Bruce Daily. That is hitting that psychological level of the 5% range. That is when people are really going to be excited to purchase. So, of course, when we were getting down and moving towards the fives and hit the fives, people rush out and start going under contract because they've been waiting for that to happen, that psychological level. Well, now here through the month of February, rates have been higher. Things have slowed down again. So when she reports for the month of February, which will be in the month of March, she's going to have some terrible report and say how terrible things are. But by the time she's putting that report out, we might be having a great March. So you always have to remember the time frame that these reports are covering and what was going on, which is why you pay attention to the Brent Bruce Daily. Now, I'm going to jump in and show you the market here in just a minute and interest rates of where we are. But let's take a minute after this report because it really is telling. It's something that real estate agents need to be communicating to their buyers. Once we get to where we are consistently in the fives, the very low sixes or even the high fives, buyers are going to flood the market. Buyers are going to come back in droves because they have been waiting. There is tremendous pent-up demand. And let's face it, inventory really hasn't grown that much. Inventory in some areas of the United States is lower than it was a year ago. So what houses are they going to be able to buy? If you're going to have this huge, rush of people trying to purchase, it is going to be a seller's market. So what you need to be thinking about and communicating to your customers now is you need to go out and you need to get under contract today. Be aggressive today when there is some inventory still. And as the inventory grows going into the spring months, jump in soon because once those rates get lower and it's really the hot time of the selling season and buying season, which is going to be the end of the second quarter as people are trying to move their kids while they're out of school. I don't want to say it's going to be too late, but it's going to be very difficult. So understand that you're kind of using a little bit higher interest rate to create a little bit of a buyer's market, and you need to take advantage of that while we still have it, because I do not believe we will have it for very long. So let's take a look and see where we're at on our charts here. We are currently sitting at being up 9 basis points on our mortgage-backed security. 10-year Treasury is down 2, sitting at 3.92, guys, still dangerously close to that 4% where we don't want to be. Taking a look over here at our charts, this is the mortgage-backed security chart. You can see that we are really just kind of dancing along this line here. You can see there's some sort of level that we're really kind of bouncing off of, and I think we'll probably see this come out, some sort of number that will come out that tells us why we're bouncing off of this. But you can see that there is some sort of a technical level that people are paying attention to. We are currently above the Fibonacci, which is 99,711, and trying to stay above and create a floor of this 99,845. We hope that we'll get above that and start to come up against the Fibonacci level here. We've got a long way to go to get back to where we were here, which again, we were talking about the 5.875 with no points right here. Now, what happened at this point? This was when we got that crazy employment report that nobody seems to understand where in the world these numbers came from. Still to this day, no one knows where these numbers came from. And then we had our CPI report come out, our PPI report come out, our PCE report, which was really bad, really out of left field for what we had expected. So these reports just did not help us. They weren't aggressive enough in bringing down inflation for the markets to like that. So what do we have going on, and when are we going to see these reports? And we'll look at the interest rates in just a minute. Okay, so March 10th is that next jobs report. So that is this. This is what happened on the 3rd of February. Okay, we saw that is when we began to turn and drop back down. That jobs report for the month of February is coming out March 10th. So a very, very big number. March 14th is our consumer price index report. March 15th is our producer price index report. March 22nd, the Fed is going to be meeting again. So we will get another reading from the Fed and an adjustment from the Fed on how they are going to treat the federal funds rate. Now, if we don't get some pretty darn good numbers on the PPI, the CPI, and the employment number, the jobs number that comes out, those are the three reports that are coming out before the Fed meets again. They're going to have to be very aggressively showing inflation coming down at this point, because we had such a rough February. It really opens the door for the Fed to even be talking about raising the federal funds rate by maybe a half instead of that quarter that we were looking for. So it's going to be very important that these reports come out in our favor so that we don't see too far of a move from the Federal Reserve. And then on March the 31st, we'll get our personal consumption expenditures report. So that's kind of what we see going on during the month. So let's take a look and see where we're at on our interest rates at this point. Looking at the Brent Bruce Daily, the very well qualified 30-year fixed conventional 800 FICO score, 25% down, single family residence, primary residence. We're going to open this up here for compliance purposes, show you the numbers that I'm looking at. And once again, this is without any discount points. This is without any origination points. This is the actual 0-point loan that I have for clients that are very well qualified. Currently 6.75% with a little bit of a credit here of $821. If someone is willing to pay a point, we are looking at about 6.25% right now, and only $223 to get to 6.625. That's a lot better than when we were, right? We were at 6.875 pretty easily just a few days ago. So we are drifting down a little bit with kind of the settling of everyone seeing these reports. And I'm looking forward to these reports coming out in March, because I think that we're going to see a very different response to these reports that come out in March, and we'll get ourselves back on track. Be ready for the fives to be coming out again very soon. So it may be a very fun March. I'm going to keep you posted. Thanks for watching. Make sure that you like, subscribe, and share, and I will talk to you again tomorrow.